Welcome to Volume 3 of Pepper Presents. My name is Caroline Mirakian, Head of National Accounts at Pepper Money. The topic this week is centred around how consumer behaviour may have changed since the pandemic and how this will impact the intermediary markets going forward, along with any opportunities that may exist for our broker partners. The learning objectives following this webinar will be to understand how consumer behaviour has changed since COVID-19, make intermediaries aware of key points that they need to know as a result of this changed behaviour, what opportunities are there for our broker partners, and how can Pepper Money help? Consumer behaviour and spending patterns have certainly changed since lockdown. That is very clear indeed. And for many people, COVID has changed their priorities around what's important, while others face ongoing financial uncertainty. Consumers have started to change how and when they shop, with many using multiple digital channels on a greater scale, or for the first time. EY Future Consumer Index back in May carried out a survey which found that 51% of consumers said that the way that they shop will fundamentally change for the long term. YouGov has recently reported that 54% of Britons have spent less money than they ordinarily would, with those in the 25 to 34 age group who have most consistently reduced their spending. And 7 in 10 have stated their expenses have decreased, the largest contributing factor being transport. And a large majority also say they've decreased their outlay on holidays and travel. And 56% non-digital services such as dry cleaning and haircuts. A small minority have seen their savings increase and debts go down, improving their financial situation, with 1 in 6 putting more money in savings than they otherwise would. And those people who have been able to work from home have noted their finances have been positively affected, with a third saying the pandemic has certainly improved their disposable income. A quarter have saved more and 1 in 7 have paid down debts. So this could be a development that continues into the future with a trend towards more permanent home working. So what is clear is the focus for many of us during this pandemic is on our most basic needs. So personal health, food and medicine safety, personal safety, financial security, health of friends and family. Self-fulfillment needs are not a priority for many people, with hobbies and entertainment taking a backseat, especially during the lockdown period. While a minority are financially better off, those with existing financial difficulties are now in an even worse position, and 44% of Britons feel less financially secure. Research carried out by YouGov recently has found that it is workers who are already financially distressed who are more likely to have experienced a change in their employment during the pandemic. Half of all workers have lost some of their income as a result of the crisis, and this number rises to 77% for those who were already financially distressed. And while a fifth of all workers are furloughed, this figure rises to 29% amongst the already financially distressed, meaning they may be at greater risk of redundancy in the coming months. The research also found that Brits who were already struggling to keep up with bills have taken a big blow from the pandemic, with 1 in 6 defaulting on all regular payments. And UK Finance showed that 1.82 million mortgage payment holidays were issued, equivalent to 1 in 6 mortgages issued by lenders. So it is without doubt that whilst the COVID-19 pandemic has impacted on all our lives, it has done so in so many different ways, particularly when it comes to how people earn their money and manage their finances. The pandemic has been a great leveller in some ways, but it has also put great financial strain on some sections of society than others. The common denominator is that everyone will be in a position they were not expecting and will benefit hugely from professional financial advice to guide them in their future decisions. So how have consumers needed to adapt when applying for a mortgage? So inevitably, we have seen an increased number of applications being undertaken online, with brokers and mortgage advisors providing the majority of their advice via telephone or via virtual means such as Zoom, Teams or Link, as opposed to being able to see their consumers face to face. Is this the future? Many ask. And the answer is we have seen consumer behaviour change, we have seen consumer behaviour spending change, and as EY Consumer Future Index highlighted, consumers felt, or should I say 51% of consumers felt, this was going to be the long term. So if I was going to be a betting lady, I would suggest that we were going to see a hybrid. And what I mean by that is it is very likely that at least half of our consumers will actually continue applying for mortgages over the phone, over virtual means such as Zoom, where they can do it in the convenience of their own home as opposed to going out to face, whilst the remainder will also wish to go and see their broker partners or their mortgage advisors in the flesh, in the office, wherever it may be. During this pandemic, we've also seen mortgage applications have increased bolt-ons in their automations, such as EID, automated valuations, which again has made consumers need to adapt accordingly when applying for a mortgage. But the good news and the positive about the pandemic is that the market is now open for business, with estate agents adapting and being able to offer property viewings. And again, in some cases, via virtual means. Rates are now the lowest they've ever been. So from a mortgage perspective, there is so much opportunity out there for consumers to look at their finances, look at the potential for purchasing a home or remortgaging. And we've got the added benefit that from the 8th of July, changes to stamp duty were made to help more home movers and first-time buyers. And now mortgage products are now available. At the start of lockdown, there were 20,000 products. Now we are down to 10,000, but there are still lots of mortgage products available for all our consumers, and also despite the reduction of low deposit mortgages. And we've seen a combination of great saving opportunities and falling mortgage rates, which will help a significant number of first-time buyers purchase a home sooner than planned. One additional point I'd like to highlight is, though, affordability has had an additional meaning. If you're employed, lenders are now conducting extra checks. They're looking into whether you've been furloughed or if you work in an industry that's been highly impacted by the coronavirus. And self-employed people have also faced extra questioning. Lenders no longer want to see just the bare 2 to 3 years accounts. They also now want to ensure that the business is still viable and able to continue, so that they are able to maintain their mortgage payments, not just now, but also in the future. With consumer behaviour changing, what does this mean for our broker partners? So we recognise that in the current environment, with finances impacted, products being withdrawn or lenders having stricter criteria, it could be harder to secure a mortgage. So in our opinion, this presents an opportunity for our broker partners to help more clients than ever before, as well as lead to a shift in behaviour, as they may find they may need to work with a wider selection of lenders, particularly make more use of specialist lenders to provide solutions for the diverse needs of the post-COVID consumer. The lockdown has further accelerated the need for technology, so for intermediaries there will be a newfound and lasting reliance on technology as people adapt to this new normal, with meetings carried out by telephone or virtual means such as Zoom. As I spoke about earlier, what I think we'll find post-COVID is a hybrid, where 50% of consumers at least will rely more on virtual means, with the remainder wanting to have an element of face-to-face. Now, we know that awareness of mortgage brokers currently is relatively good. In recent research that we carried out in an adverse credit paper, we found that 4 in 10 people would actually speak to a broker if they required advice. However, more people say they would go directly to their bank, and even more of 58% would seek advice from family and friends. So when it comes to finding a broker, 49% said they would use online research to identify the right advisor to meet their requirements. So based on this finding, if I could give a broker a couple of tips based on this today, it would be, if you have a website, update it. Let customers know what situations you can deal with. Maybe even just about how you operate via virtual means. Let family and friends also know your services, as well as keep in contact with your existing customer base. They may not need you right this minute, but they may need you later. So In summary, there is a huge opportunity out there for our broker partners right now, and also to tell a coherent story to our lenders that helps them in their decision-making process. So consumer behaviour is not only had to adapt due to COVID, but also brokers have, and our lenders too as well, to ensure that we are getting to grips with the changing consumer needs and behaviours and able to meet their mortgage needs. And as we've seen, the biggest area of difficulty at present, or the discussion point, is very much about around 90% loan-to-value lending, with a few lenders back in the market, but being forced to either limit applications on a tranche basis or pulling out again quickly due to the sheer volume of applications. Lenders are also working very hard in the background to ensure that they are able to service their customers who have been on furlough or who have seen dips in income in their self-employed activity. Lots of questions in the background that are all being looked at currently to make sure that we are able to adapt and able to assist those customers with mortgage requirements. But what I will add to this is, whilst all these considerations are carrying on and lenders are working incredibly hard to make sense of the changing needs, affordability is certainly taking an additional meaning, and you may find experience of lenders now asking more questions to understand what is going on with the client's circumstances, to be able to really service them, and to make sure that we are also lending responsibly. Because a difficult question lies is, for example, a furloughed worker, how many will actually return back to their jobs over the next few months? Lending a vast sum of money to someone now in the knowledge that they may not have a job in 3 months' time leaves them wide open to future issues. So it's about lending responsibly, but also being able to adapt. And I think over the time period, we will see lenders adapt more and more to make sure that we are able to fully service the post-COVID customer. How can Pepper Money help some of your customers? We are in a very fortunate position where we have lending capacity. We have ability to look at your customers' circumstances and see how we can help them, particularly as they've adapted during the post-COVID pandemic. We have flexible criteria to meet the demand of the changing consumer. We provide a range of residential and buy-to-let products. And the beauty of our proposition is that we manually underwrite all our cases to provide those solutions to those who we feel are underserved borrowers in this current market. So if you've got a customer who's back on track with their finances and able to meet their mortgage repayments, we don't believe past events should stop them from being considered for a mortgage. And we don't credit score to make decisions. So how can Pepper Money help during this pandemic? Well, it's certainly clear that consumer behaviour has certainly changed and adapted. And during this time, it is important to know what key areas a lender can assist with. So I thought I'd put down a few points as to where we may be able to help. Number one being around capital raising. So we will capital raise for any legal purpose, excluding tax bills and business debts. We can consolidate debt up to 80% loan to value with no debt to income ratio, and there are no pound limits. And if your consumer has a number of CCJs and defaults, don't write off their chances for a mortgage, because we will be happy to look at it. So those who may have had an unexpected credit blip, we take a time-based approach to CCJs, defaults and mis-secured payments. And CCJs and defaults, when they're registered over 12 months with a £2,500 limit on value, we will be happy to look at them. And there's no requirement for them to be satisfied, and some small defaults can be ignored. In terms of submitting an application to us, we have evolved with the times, and we have recently upgraded our online mortgage portal, which will enable you to submit an application very quickly and smoothly to us. And you even have the beauty of getting a direct access to an underwriter, so you can speak to the mandated holder about your client's circumstances. As well as we have launched a new product range directly to support those customers who may not have any CCJs at all. And here's an example of how Pepper Money have helped one of the consumers during the pandemic. So the background being married couple, Frank and his wife Linda, who both lived in the southwest of England. Now their home was valued at £275,000 and they had an outstanding mortgage on their property of just £148,000. Now over the years the couple had built up a large amount of unsecured credit and was struggling to meet the monthly commitment on these debts. And to help pay off these debts, they decided that actually now, whilst they were at home It was time to remortgage their home because rates have been the lowest that they've ever been. But the issues that they faced were that being able to secure a remortgage wasn't as simple as they'd hoped. They'd encountered unexpected and significant costs, and without savings had a large amount of unsecured debt. And despite having good incomes and a strong payment profile, they were being turned away by high street lenders because of their credit score. So the solution was they spoke to a broker who undertook their meeting via Zoom and were able to identify that Pepper could actually help these customers. Our underwriters were then able to consider Frank and Linda's circumstances because we really understood what was going on in the customers' lives, including their income and their payment profile. And then we finally agreed to a debt consolidation remortgage up to 80% loan to value. So in summary, consumer behaviour is certainly changing. That is without doubt. So this means that we all need to embrace the change and adapt to the way we are able to help customers in the new world, whether it be by offering more flexible criteria or by simply the way we have to interact with them going forward via technological means. This change, though, provides us a great opportunity to work together. Lenders, brokers and customers all coming together as one. And for broker partners to genuinely grow their businesses as an increasing number of customers may need guidance. As I alluded to earlier before, if you don't have a website, get one. If you haven't updated it, update it. Let people know the services that you are able to offer. Speak to as many family and friends as possible because actually they may not need you now, but they may need you in the future. Stay close to lenders as well. Speak to the BDMs. Let them help you. There is a lot of business out there. So let's talk to each other and work through the opportunities so that we are able to adapt and support the changing consumer. Thank you very much for today and for listening, and hope that you have found this really insightful. And I hope that you look forward to Volume 4 of Pepper Presents. Goodbye.